The Canadian dollar is gaining momentum, climbing to its strongest level against the US dollar in more than 2 months as weaker US economic data and stronger Canadian manufacturing figures narrow the gap between the two economies. The loonie was recently trading around 1.3875 Canadian dollars per US dollar, up roughly 0.4% on the day. Earlier in the session, it reached 1.3865, its strongest intraday level since June 3rd. For the week, the Canadian dollar was up about 0.5%, putting it on track for a third consecutive weekly gain. So what's driving the move? A major factor is the changing outlook for Federal Reserve policy. Markets have been reducing expectations for additional U.S. monetary tightening following a series of weaker economic indicators. That shift has pushed U.S. and Canadian short-term bond yields closer together, reducing one of the advantages that previously supported the U.S. dollar against the Canadian currency.
According to Scotiabank strategists Sean Osborne and Eric Theoret, the decline in expectations for further Federal Reserve tightening has already produced a significant narrowing in short-term interest rate spreads. Since the end of July, the difference between Canada's 2-year government bond yield and the equivalent U.S. Treasury yield has narrowed by approximately 17 basis points, although the U.S. yield remains about 120 basis points higher. This narrowing is important for the Canadian dollar because interest rate differentials are one of the key drivers of currency flows. When the U.S. yield advantage becomes smaller, investors have less incentive to hold U.S. dollar assets purely for the higher return, and that can provide support for the Canadian dollar. The latest U.S. economic data added to that trend. U.S. retail sales unexpectedly declined in July, raising concerns about the strength of American consumer spending.
At the same time, Canadian economic data came in stronger than expected. Canadian manufacturing sales increased 0.1% in June from May, marking the 5th consecutive monthly increase. More importantly, manufacturing sales volumes rose 1.2%. Separate data showed Canadian wholesale trade increasing by approximately 2.8% in June. The combination of weaker U.S. data and relatively stronger Canadian numbers has shifted the recent pattern of economic surprises in favor of Canada, and that could continue to support the loonie. Another major factor is oil. Canada is one of the world's largest energy exporters, meaning movements in crude prices can have a significant impact on the Canadian dollar. Oil prices were trading around $81.88 a barrel, up roughly 0.8%, as geopolitical tensions involving Iran increased concerns about potential disruptions to Middle Eastern crude supplies. The United States has threatened an indefinite naval blockade of Iran, adding another layer of uncertainty to the global oil market.
If crude prices remain elevated, that could provide additional support for Canada's currency. However, there is also a risk. Higher oil prices can contribute to global inflation. If energy prices rise sharply, central banks could become more cautious about cutting interest rates. For the Federal Reserve, that could mean maintaining tighter policy for longer. So the Canadian dollar is currently benefiting from two major forces, a weaker U.S. dollar and stronger commodity prices. But the outlook could change quickly if inflation expectations rise again. Canadian bond yields also moved higher on Friday. The Canadian government bond curve steepened following the broader move in U.S. Treasury yields. The benchmark 10-year Canadian government bond yield rose approximately 5.5 basis points to 3.681%. Despite the increase, it remained below the recent 2-year high of 3.755% reached earlier in the week. Meanwhile, the U.S. dollar weakened against a basket of major currencies following the disappointing retail sales report. That broad-based dollar weakness has provided another tailwind for the Canadian currency.
What comes next for the Canadian dollar? The key question now is whether the loonie can maintain its momentum. The Canadian dollar has already recorded 3 consecutive weekly gains if this week's advance holds. The next major driver will likely be the difference between U.S. and Canadian economic performance. If U.S. growth continues to slow while Canadian data remains relatively resilient, markets could further reduce expectations for Federal Reserve tightening. That would potentially narrow the interest rate gap even further and create additional support for the Canadian dollar. Oil prices will also remain critical. Any escalation in Middle Eastern tensions that threatens crude supplies could push oil higher and provide another boost to Canada's resource-linked currency. But if geopolitical tensions ease and oil prices retreat, some of that support could disappear. Investors will also be watching upcoming inflation, employment, and central bank policy signals from both countries. For now, the message from the currency market is clear.
The Canadian dollar is gaining ground because the U.S. economic outlook is showing signs of weakness. Expectations for aggressive Federal Reserve tightening are fading, Canadian manufacturing data is holding up, and oil prices remain elevated. The loonie has now reached its strongest level since early June, and the narrowing U.S.-Canadian yield spread suggests the move could have further room to develop. However, the Canadian dollar still faces an important test. If upcoming U.S. data continues to disappoint and Canadian economic figures remain firm, the loonie could extend its rally. But stronger U.S. data, renewed inflation concerns, or a significant decline in oil prices could quickly shift the balance back toward the U.S. dollar. For now, though, momentum is clearly moving in favor of the Canadian dollar, and traders will be watching closely to see whether this 2-month high marks the beginning of a larger trend or simply another temporary move in a highly volatile currency market.